Let me ask you something real quick. What does owning a home mean to you? Like, genuinely, close your eyes for a second and picture it. A yard, a garage, a kitchen that's actually yours. No landlord texting you about the lease renewal. No random rent hike in March because the market shifted. Just yours. That image is powerful, and for decades, Americans held on to it like gospel. Work hard, save a little, buy a house. That was the deal. That was the dream. But here's what nobody told you. That deal changed, quietly, brutally, and without any announcement. And right now, in 2026, the math behind buying a $500,000 home, which, by the way, is not a mansion, it's a pretty average house in most American cities, the math is so ugly that most people who think they can afford it actually cannot. And most people who think they can't, they're right. So today we're going to do something that almost nobody does before signing a 30-year mortgage. We're going to actually run the numbers, all of them, the ones the lender glosses over, the ones the realtor conveniently forgets to mention, the ones that show up 6 months after you move in and make you wonder what you were thinking. And by the end of this, you're either going to feel completely vindicated for renting, or you're going to understand your mortgage in a way you never have before. Let's get into it. First, let's establish what we're actually talking about when we say a $500,000 home. According to the National Association of Realtors, the median existing home price in the United States hit approximately $407,000 in early 2024. But that's the median. In cities like Austin, Denver, Nashville, Miami, Seattle, and basically anywhere within commuting distance of a major job market, $500,000 gets you something modest. A 3-bedroom, 2-bath, maybe a small yard. Nothing extravagant. Nothing that would make your jaw drop. So we're not talking about luxury real estate. We're talking about a normal house in a normal city that a normal working family might actually want to buy. That's the target. And the household we're stress testing this against, the real median household income in America, which according to the U.S. Census Bureau sits at about $74,580 a year. Again, that's median, meaning half of American households earn less than that. This isn't some low-income scenario we're constructing. This is the literal middle of the American income distribution. Now watch what happens when these two numbers meet. Step 1, the down payment. Everyone knows you need a down payment, but how much do most people actually put down? The common advice you hear is 20%. 20% of $500,000 is $100,000. $100,000. Just sitting in your savings account, liquid, ready to hand over at closing. Let's pause there. The Federal Reserve Survey of Consumer Finances found that the median American family has about $8,000 in savings. Not $100,000, $8,000. So right out of the gate, the conventional path to homeownership requires saving an amount of money that the typical American household does not have, and at the savings rate most people operate on, would take decades to accumulate. Now some of you are thinking, okay, but what about 3% down? What about FHA loans with 3.5%? That's real, that's a valid option, and we're going to come back to it. But the moment you go below 20%, you trigger something called PMI, private mortgage insurance. And that cost is going to show up in a minute, and it's not pretty. So let's say our household manages to pull together a 10% down payment. That's $50,000, which is still a significant chunk, but more realistic than $100,000. That means they're financing the remaining $450,000. Step 2, the mortgage payment. At the time this script was written, the average 30-year fixed mortgage rate in the United States was hovering around 6.8 to 7%, based on data from Freddie Mac's primary mortgage market survey. That's not some weird outlier rate. That's the environment we're in. So let's run the math. A $450,000 loan at 6.8% interest over 30 years gives you a monthly principal and interest payment of approximately $2,933. Nearly $3,000 a month, before anything else, before taxes, before insurance, before you've even thought about your electricity bill or your groceries. But we're not done, because that number is just principal and interest. The mortgage payment that actually hits your bank account every month is going to include several other things. Step 3, property taxes. Property taxes vary by state and county, but the average effective property tax rate in the United States is about 1.1% per year according to the Tax Foundation. On a $500,000 home, that's $5,500 per year. Divide by 12 months, and you're adding approximately $458 to your monthly payment. Some states are worse. New Jersey, Illinois, and Texas homeowners pay effective rates well above 2%. So on that same $500,000 home in New Jersey, you might be adding closer to $800 or $900 a month just in taxes. We'll use the national average for our model, so $458 per month. Keep that number in your head. Step 4. Homeowners insurance. According to Bankrate, the average cost of homeowners insurance in the United States for a home valued around $500,000 is roughly $2,000 to $3,000 per year. Let's call it $2,400, which puts us at $200 per month. And yes, this figure varies widely depending on where you live, how old the home is, whether you're in a flood zone or a fire risk area. In Florida and Louisiana, homeowners insurance has become genuinely catastrophic in the past few years. Some homeowners are paying 5 or 10 times the national average, but again, we'll use the moderate national figure, $200 per month. Step 5. PMI. Remember when we said the household was putting 10% down instead of 20? Here's where that decision costs you. PMI, private mortgage insurance, is required by lenders when you put down less than 20% because it protects the lender, not you, if you default. The cost of PMI typically runs between 0.5 and 1% of the loan amount per year. On a $450,000 loan at 0.8%, that's $3,600 per year, or $300 per month. $300 every month for insurance that does not benefit you in any way, just sitting there, protecting the bank, until you've built enough equity to remove it. Now let's stack all of this up. Principal and interest, $2,933. Property taxes, $458. Homeowners insurance, $200. PMI, $300. Total monthly housing payment, $3,891. Nearly $4,000 a month. That's your cost to own this home before you've paid a single utility bill, before you've bought a piece of furniture, before you've touched a single maintenance issue. And that brings us to the number that most people completely forget about. Step 6. Maintenance. This one is the silent killer of homeownership budgets. The general rule used by financial planners is the 1% rule. Budget 1% of your home's value per year for maintenance and repairs. On a $500,000 home, that's $5,000 per year, or $417 per month. Is that accurate? Let's think about what that actually covers. A new water heater costs $800 to $1,500. A roof replacement on an average-sized home runs $8,000 to $15,000. HVAC repair or replacement, $4,000 to $12,000. Plumbing issues, electrical work, foundation cracks, pest control, appliance failures. It adds up fast and it's unpredictable. Some years you spend nothing. Some years the furnace dies in January and the basement floods in February. The 1% rule is not pessimistic, it's a reasonable average over time. So add $417 per month to our total. That brings our true monthly cost of homeownership to $4,308 per month. $4,308 every single month. Now let's put this against our household income and watch what happens. Our household earns $74,580 per year. That works out to roughly $6,215 per month in gross income before taxes. After federal income tax, state income tax, Social Security, and Medicare, a household in this income range typically takes home somewhere between $4,400 and $4,800 per month, depending on their state and filing status. Let's be generous and call it $4,700 per month in net take-home pay. Are you seeing the problem? Their total monthly housing cost is $4,308. Their total monthly take-home pay is approximately $4,700. That means after paying for the house, this family has less than $400 left over every single month for food, transportation, healthcare, childcare, clothing, and every other expense in their lives. That is not a budget, that is a financial trap. And here's where it gets even more uncomfortable. Most financial advisors use what's called the 28% rule as a guideline for housing affordability. The idea is that your monthly housing costs should not exceed 28% of your gross monthly income. This rule is used by mortgage lenders as well when evaluating your application. 28% of our household's gross monthly income of $6,215 is $1,740 per month. The actual cost of carrying this home, $4,308. That's 69% of gross monthly income, more than double what the 28% rule recommends. The lender might still approve this loan, by the way. Lenders look at something called the debt-to-income ratio, and they use your gross income, not your net income. They also typically look at a narrower definition of housing costs than our full calculation. So a household in this range could technically get approved for this mortgage. They could sign on the dotted line. They could get the keys. And then spend the next several years being completely broke. Now let's talk about the conversation people don't want to have. What income do you actually need to comfortably afford a $500,000 home? If we work backward from the 28% rule, and we use our full monthly housing cost of $4,308, you'd need a gross monthly income of about $15,380. That's an annual household income of approximately $184,000. $184,000 per year to comfortably afford what the market currently calls an average home. The top 10% of American earners make around $167,000 or more. So by this math, even a household in the top 10% would be stretching to buy this house comfortably. This is not a problem with individual financial discipline. This is a structural problem with the housing market, and understanding that distinction matters because it stops you from blaming yourself for something that is genuinely, mathematically, not your fault. Let's talk about the other costs nobody mentions, the ones that hit you after you've signed everything. Closing costs. When you buy a home, you pay closing costs on top of your down payment. These typically run between 2 and 5% of the purchase price. On a $500,000 home, that's $10,000 to $25,000 due at closing in addition to your $50,000 down payment. So the true upfront cost of buying this home, $60,000 to $75,000, minimum, out of pocket on day one. HOA fees. If your home is in a neighborhood with a homeowners association, which is increasingly common in newer developments, you might be paying $200 to $500 per month in HOA fees on top of everything else we've already calculated. Moving costs, utilities setup, landscaping, window treatments, all the things you didn't have to think about as a renter that now cost real money. The financial iceberg of homeownership is enormous. The mortgage payment is just the tip that people see. Everything below the surface is what sinks people. So where does that leave us? What's the honest takeaway here? Let me be direct with you, because I think you deserve that. Renting is not throwing money away. I know you've heard the opposite your whole life, but when you rent, you're paying for housing, a real thing you need. When you own, you're also paying massive amounts in interest, property taxes, insurance, and maintenance that also never come back to you. The difference is that as a renter, your costs are predictable and your flexibility is high. As an over-leveraged homeowner, your costs are unpredictable and your flexibility is gone. That doesn't mean you should never buy. Homeownership can absolutely build wealth over time, particularly if you buy at a reasonable price relative to your income, stay in the home for 7 to 10 years or more, and have genuine financial stability before you enter the deal. But buying a $500,000 home on a $74,000 household income in 2026 is not a wealth-building move. It's a hope-based financial decision, and hope is not a strategy. So what should you actually do? If you're renting right now and feeling behind, here's your reframe. You're not behind, you're liquid. Liquidity is a financial superpower that homeowners have given up. Use it intentionally. If your rent payment is substantially lower than what a mortgage on the same place would cost, invest the difference. Put it in a low-cost index fund, build your emergency fund to 6 months of expenses, and let the market work for you while you maintain your optionality. If you want to buy eventually, start with the 28% rule as your anchor. Figure out what home price that income threshold supports for your specific situation, your state, your tax rate, your insurance costs. Work backward. Know the number before you fall in love with a house. If your employer offers any kind of retirement match, capture every dollar of that first before you redirect savings toward a down payment. Free money beats everything. And if you're already a homeowner who bought more than you should have, you're not alone and you're not doomed. Refinancing, house hacking, renting out a room, aggressively building equity through extra principal payments, there are levers to pull. But be honest with yourself about the situation, because denial is what turns a tight situation into a financial crisis. Here's the bigger truth I want you to walk away with. The American housing market is not designed to make homeownership easy for the median American right now. It's just not. Prices were inflated during COVID by historically low interest rates, remote work demand, and speculative buying. Then rates went up fast, and the prices didn't come down to match. The result is the worst affordability environment in decades. According to the Harvard Joint Center for Housing Studies, housing affordability in the United States reached a 40-year low in 2023 and has barely recovered since. That's not your generation being lazy. That's not avocado toast. That's a systemic imbalance between wages, home prices, and interest rates that no amount of personal discipline fully overcomes. So be smart, be patient. Know your actual numbers, not the ones the listing agent shows you, not the pre-approval amount the bank dangles in front of you, but the real, complete, annualized cost of owning that specific house with your specific income. Because the goal isn't to own a home, the goal is to build a life. And sometimes the most powerful financial move you can make is choosing not to buy something you can't actually afford, even when everyone around you is telling you that you should. Run the numbers, trust the math, and build your future on facts, not feelings. That's the real deal.